What if I told you that dividend stocks don't actually make you richer? That every dividend you receive quietly reduces your stock price, and yet millions of investors still swear by this strategy. Today, we're diving into one of the most popular investment strategies of all time, the dividend strategy. So today, we're breaking down the dividend strategy, what it is, when it works, and when it absolutely doesn't. What dividends really are, the real pros and cons, and whether this strategy fits your financial goals. Let's start. Investors who follow the dividend strategy focus on stocks that pay high and consistent dividends, often for decades. A dividend is a portion of a company's profits, paid directly to shareholders. Companies are not required to pay dividends. They can reinvest profits instead, and many do. Dividend yield is calculated as annual dividend divided by stock price. That's why you'll often see dividend yields listed on finance platforms. Your total stock return comes from two sources: price appreciation plus dividends. Sounds simple, but here's the catch. When a dividend is paid, the stock price drops by the same amount. This is called the dividend cutoff. Example, stock price, $100 dividend paid, $5. New stock price, $95. You didn't gain extra money, the value was just transferred. Here's where it gets interesting. Dividend stocks often overlap with value stocks. Established companies, stable cash flows, conservative growth. Legends like Benjamin Graham and Warren Buffett favored value investing and made fortunes. Critics argue, dividend investing is just a simplified, weaker version of value investing. Let's be honest. Dividend investing means less diversification, more work picking stocks, higher taxes, dividends are taxed immediately, lower growth potential, less tax efficient than buy and hold ETFs. High dividends are often already priced into the stock, meaning future returns may be lower because dividends feel real. Think of real estate. Would you buy a property that pays no rent for 20 years and only hope for appreciation? Dividend investors want cash flow. There's also a powerful psychological effect. Regular income, motivation to keep investing, less panic during market crashes. Studies also show companies paying dividends tend to waste less money because cash leaving the company can't be mismanaged. Dividends are not guaranteed. They can be reduced or completely canceled, especially during crises. They are not interest payments like bonds. If you rely on dividends as income, you must accept volatility. The dividend strategy isn't about maximizing wealth. It's about building predictable cash flow. If your goal is passive income, psychological comfort, regular payouts, then dividend investing can make sense. If your goal is maximum long-term growth and investing in growth stocks, global diversification, and value ETFs may be better. If this video helped you, hit the like button, comment below. Dividends or growth, what's your strategy? And subscribe for more clear, honest investing insights.